So one of my biggest fears as an investor is to see my money worth less than what I started investing with, because my goal is to have enough dividends and passive income to pay for my lifestyle. But what if my stocks were worth less and worth $0 at some point? Now, if you've ever lost money investing in the stock market, don't worry, because billionaire investor Carl Icahn just sold his Hertz position for 72 cents per share, and that represents $40 million worth of profit, which sounds like a lot of money. And it is, until you realize that's actually a loss of $1.8 billion of his original investment. The Hertz new slogan is, "We make millionaires out of billionaires." No, I'm just kidding. Their actual slogan is, "Our stock prices are so low, it hurts." Now, I don't know about you, but with everything going on in the stock market right now and Hertz declaring bankruptcy, it made me wonder what happens when a stock actually goes to $0, and can that even happen? So let's say you want to invest and you're really excited to get started, so you Google how to start investing. You whiz right by the Vanguard Boglehead forums that show you exactly how to do just that, but substance is always boring and YouTube videos rank higher. So you see this pale-looking idiot staring at you with a clickbait thumbnail like, so you click that video and you hear complicated words like dividends and compound interest, and maybe in that video you see how he takes a $5 bill and turns it into a $100 bill like the dark magician that he is not. So you say, hey, I could trust this guy. So you buy your first stock, but instead of making money, this ends up happening instead. Don't worry, my wallet's not actually on fire. It's all an illusion and what one hot investment looks like. Straight from YouTube. But I promise, if you actually watch this video, it will save you a ton of money from making a costly mistake, and I'll show you exactly what the signs are to watch out for when a stock is dropping to $0, and if it does, I want you to know exactly what would happen if you had your money invested in it. Let's begin. Hi, my name is Andrei Jikh, and who wore it better, Kaiba or the PS5? I agree, Kaiba. Alright, so most people think that when a company reaches $0 in stock price, that's when it goes out of business. But that's not at all reality, because people place a huge importance on the price, but here's how it actually works. It's price that follows reality, and it's price that follows bankruptcy. And a company must first declare that it's run out of money and go bankrupt before the stock price can reach $0, which, contrary to what most people think, never actually ends up happening at all. In order for a stock to reach $0, there would have to be somebody left to sell you the stock for $0, and that doesn't make any sense, because if you had a stock that was worthless, you wouldn't go ahead and try to sell it for free. You would just hold on to it, which is why we don't see $0 stocks in our favorite brokerages. Instead, what ends up happening is the price just keeps going lower and lower and lower until eventually there's no more people left to buy it. But once this happens, then the worst fate to a stock actually occurs, and this is when it gets delisted, which is a simple way of saying, somebody Raigekis it on out of the exchange where you can no longer buy or sell the stock. And this happens when the stock price itself falls below a certain minimum threshold to qualify for that particular exchange. For example, the NYSE, the New York Stock Exchange, has a minimum list price of just $1 per share. Anything that's less than that means that that stock gets delisted from the exchange if it holds that price for an extended period of time. Another exchange, the NASDAQ, has a minimum list price of just $4. But I don't have a $4 bill, so this will have to make do. In order to understand exactly how that works, there are two major components to this: Russian components and American components. Sorry, I just watched Armageddon and I thought of Lev Andropov, the Russian cosmonaut. And component number one is intrinsic value, or real value, which is determined by adding up all of the assets that a company owns minus the liabilities or debts. And as long as the result or the difference between these two is positive, then the company is considered solvent. In other words, it still has money, and that is intrinsic value. Investors try to get as close as possible to this number to get an accurate understanding of what the price should be. But that is not what you and I see when we open up apps like Robinhood. Instead, what we see is component number two, the market price, and that is driven by supply and demand, news, and sentiment of things that we see and things that we hear. But to keep it simple, think of these two things like the two sides of your brain. Component number one is logic, and component number two is emotion. And sometimes emotion is driven and inspired by logic, but more often than not, emotion is not an accurate way to judge a real intrinsic value of a stock. Now, the goal is for our number one, the intrinsic value, to be higher than our number two, the market price. And the greater the difference between the two, the better better the value that we get. We want our logic to be strong and our emotion to be upset. It's how I like to invest. And if tomorrow somebody choked on a McDonald's French fry and they tried to sue McDonald's and the stock price went lower, I would try to buy the dip. But only if the French fries are still good. Let's face it, McDonald's has the best French fries and In-N-Out has the best burgers. I'm just getting hungry. Now, if the assets minus liabilities go negative, then we have ourselves a situation. A real world example of this is a company whose services I loved abusing. I mean, using. I remember Corey and I went to LA and we went to the Grove, great mall, overpriced movie theater, and we each paid $17 per person using MoviePass. And it was right there and then that I knew that this would not end well. Because how could a company that charged customers $10 a month be expected to make money? I would have loved to sit in on the investor pitch meeting that helped them get funding to start their company. Hi, this is what we're gonna do to your money. Anyway, MoviePass dropped below a certain price because people stopped buying it, and when they did, it got delisted, which meant you couldn't even buy or sell the stock anyway, which meant if you had any money in it, your investment became worthless. But Andrei, what if I hold on to those stocks that are worth nothing because maybe someday in the future they will be worth something? And to that I say, that is called the sunk cost fallacy, which you want to avoid at all costs, especially with things outside of money. Sometimes you have to cut your losses and move on, because once the stock falls below a certain price, it will get delisted and you will own nothing of value unless in certain circumstances where that stock will move to a different exchange, in which case it will be worth fractions of a penny, and yes, you will own something, but that is essentially worthless. Now here's where it gets a little complicated, because a company can declare a Chapter 7 or 11 bankruptcy. In the case of a Chapter 7, it's total liquidation, like in the case of this deck of cards, where a corporation is forced to sell all the assets that it owns in order to compensate financially the kings, which in this case are the secured creditors. Now, in the case of a Chapter 11 bankruptcy, all a corporation has to do is just restructure itself and the stock doesn't actually have to fall to zero. Instead, a letter Q will be added to the end of the ticker symbol, which as we all know, stands for quitter. I'm kidding. I have no idea what the letter Q stands for, but I think we should make it official here and now. Q stands for quitter. Now, if a company survives a Chapter 11 bankruptcy, your shares can still go to $0. This is because the most likely scenario is that it will restructure itself, issuing new shares with a new ticker symbol completely independent of the old shares that you used to own. The old shares you used to own would just sit there and collect dust, as new investors would only buy the new shares of the newly restructured company, driving your old shares further down in price until eventually it hurts. And speaking of Hertz, it's absolute insanity. On May 22nd, when they declared Chapter 11 bankruptcy, check out what happened to the stock price. It went from $3 all the way down to 55 cents per share, effectively making it a penny stock, which we both know to stay away from. But then 2 weeks later, it shot up all the way to $5.53 before falling back down to around $2. And that's because the SEC ordered Hertz to stop selling shares, because they want to protect the retail investors, because they know, and Hertz knows, and what most people don't know is that there's about to be an outflow of money out of Hertz, and you and I, the retail investor, will most likely not be included in it. Companies don't just go to $0 and then that's it. They still have assets, which can be things like real estate, the cars they own, the equipment, and even their own investments, which we as investors are entitled to. What happens to all that stuff? Here's exactly what happens first in this list of priorities that a company must pay first before it gets to you and I. It's really interesting because I think most people are unaware of this. Now, the first people to actually get in line and get their money and get paid are the lawyers, but they kind of don't count. The first real people are the secured creditors. These are companies that lend their money backed by collateral or physical property. Kind of like when you go to a pawn shop and you give them your stuff and they give you money in return. You can also use your money to buy back your stuff later in the future. Then the second people in line are the unsecured creditors, which are usually the credit card companies that allow us to use their money. It's also why they charge us higher interest rates, because that money is not backed by collateral, so higher risk, higher reward. Then after the secured creditors and the unsecured creditors get their money, the third people in line are the bondholders, which hold a promise by that company that they will pay back their debt to the bondholders, which take priority over the shareholders. And even though bondholders take less risk, they also share less of the profit, less risk, less reward, but they're also more protected when a company declares bankruptcy. So after the secured and the unsecured creditors and the bondholders all get paid, if there's any money left, then finally up next is still not us, it's the preferred shareholder and then the common shareholder. We get our money last, which is why in almost every bankruptcy case, we end up with $0, which is also why you should be very careful investing in a company like Hertz, because by the time everyone else gets paid, we will end up with nothing. Now, I'm not a licensed professional, so I can't give advice, but if I wanted to avoid holding a stock that's gonna be worth $0, the most important thing that I would use first is my common sense. Does common sense dictate that a company like MoviePass can actually survive on its business model? Because if not, you have no business investing in something that's going to lose you $190,000. Are hundreds of thousands of cars that depreciate in value, that require high maintenance costs, really going to end up making investors money? Probably not, especially if that same company is warning its own investors that they will lose money buying their stock. Not a good idea. The second thing I want to know is how profitable that company is, and you can see that in their quarterly earnings reports, which can be found on many external websites or even directly on that company's website, because I want to know, how much dividends are they paying? How much debt do they have? These are all very basic things to check to see exactly how quickly they will grow or how quickly they will fall to zero. But if you do fall victim to holding a stock that's worth $0, you can still make money when you go to do your taxes at the end of the year. If your stock is no longer listed, you can still prove to the IRS that you had that stock, and they will let you write off up to $3,000 of ordinary income that year. And anything above that would be rolled over to the next year, and boom, you just made money by losing money. But no one's actually gonna end up losing money, because if you haven't heard already, the Fed might start buying stocks. As we all know, stocks can only go up in value forever. No, I'm kidding. Anything that goes up so high in value must eventually come right back up again, according to Jerome Powell. 2020, thank you, you are the best thing that's ever happened to us since the Llorona. But of course, we all know that this party must eventually come to an end at the end of this year, or maybe the beginning of next year. Or maybe never, because interest rates will be zero forever, and the printing presses will be hot and spicy. If you'd like to get started with responsible investing, you can get 3 free stocks by signing up to Webull. You'll get 1 free stock up to $250 in value. If you fund that account $100, another free stock worth up to $1,400 in value, and your 3rd free stock you can register for free from Robinhood. That's 3 free stocks to get you started with investing. You can follow me on Instagram. I post there from time to time. Love you. Thank you so much. I will see you back here on Monday and Friday. Bye-bye. Straight from YouTube. That's still on fire. And that, kids, is why you don't ever want to mess with fire.